Welcome to this week's Market Recap, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. The Federal Reserve released minutes from their most recent meeting, providing insight into how policymakers are thinking about interest rates and the economy going forward. The minutes revealed a more cautious stance than many expected. While most Fed officials supported additional rate cuts this year, several voiced concerns about inflation remaining above their 2% target. What's important here is that the Fed is balancing two competing priorities: supporting economic growth and employment while bringing prices under control. They're taking what they call a data-dependent approach, meaning they'll make decisions meeting by meeting based on incoming economic reports, rather than committing to a predetermined path. Markets are still pricing in rate cuts for both October and December, which would provide some relief for borrowers and potentially support stock prices. For investors, this environment reinforces why we focus on quality companies with strong balance sheets and pricing power. These businesses can adapt to changing interest rate conditions because they have financial strength and market position. In company news, one of Wall Street's top research firms raised its price target for NVIDIA by 25%, highlighting what they call a multi-trillion-dollar opportunity in artificial intelligence. The analyst emphasized that we're still in the early stages of companies building the computing infrastructure needed for AI, a build-out expected to continue through 2030. NVIDIA's deepening partnership with OpenAI, potentially involving up to $100 billion in systems deployment, demonstrates the real commercial opportunity here. Rather than viewing AI investment as speculative, the analyst compared it to building internet infrastructure in the 1990s, a foundational investment that created enormous long-term value. This validates our position in NVIDIA and similar companies, which will build the hardware and technology that enables AI adoption across industries. Global stock markets pulled back slightly this week as investors paused after a strong rally, particularly in technology stocks. The dollar strengthened, recording its best weekly gain in over a year. This kind of consolidation is normal and healthy after markets move higher. It gives everyone time to reassess whether current prices make sense. Asian technology stocks showed particular weakness, especially Chinese semiconductor companies. Despite this short-term pause, the underlying trends supporting quality technology and industrial companies remain intact. The pullback appears driven more by profit-taking after strong gains than any fundamental deterioration. For long-term investors, this volatility creates opportunities rather than causes for concern. We continue focusing on companies with strong competitive positions and sustainable growth, which should provide stability through various market conditions. Now let's look at what drove our performance and why we remain confident in our positioning. Three companies stood out as top performers this week, each representing different aspects of our investment approach. NVIDIA gained nearly 2%, continuing to benefit from what appears to be insatiable demand for AI computing power. Large technology companies building massive data centers keep increasing chip investments, and NVIDIA has clear visibility into strong demand that will extend well into next year, especially as they prepare to launch their next-generation Blackwell chip architecture. Microsoft rose over 1%, driven by better-than-expected Azure cloud adoption and growing success with their Copilot AI assistant. Several analysts upgraded the stock, noting that AI features are generating meaningful revenue while improving profit margins. What makes Microsoft attractive is its diversified business model, combining growth from AI and cloud with stable revenue from Office, LinkedIn, and gaming. NextEra Energy surged over 7% as utility stocks rallied on declining bond yields. Lower yields reduce borrowing costs for utilities, and NextEra stands out as America's largest renewable energy producer with predictable cash flows from wind and solar projects. The information technology sector once again led portfolio performance, with nearly all of our technology holdings posting gains. NVIDIA, Microsoft, Broadcom, Qualcomm, and ASML all contributed positive returns. What's driving this sustained strength? To start, AI-related spending is expected to extend years into the future, providing confidence in earnings growth. Supply chain challenges that plagued the industry have largely resolved, allowing companies to meet demand efficiently, and stable or lower interest rate expectations have removed a valuation headwind. The sector's strength reflects genuine business fundamentals. These companies generate substantial cash flow, report strong order books, and benefit from multi-year investment cycles in AI infrastructure and digital transformation. Our focus remains on established leaders with competitive advantages rather than chasing every technology story. Our quality strategy delivered the strongest results as investors showed clear preference for companies with proven business models and financial strength. This strategy focuses on businesses with high returns on equity, meaning they generate impressive profits relative to invested capital, combined with strong balance sheets. Microsoft led the way, while Visa, Johnson & Johnson, United Health Group, and Procter & Gamble all contributed positive returns. The common thread in these companies is their ability to generate reliable earnings regardless of economic conditions. They possess pricing power, maintain dominant market positions, and demonstrate financial discipline. This rotation toward quality reflects investor recognition that in uncertain times, businesses with proven track records deserve premium valuations. Late in an economic cycle, companies that consistently deliver profits and maintain margins tend to outperform. Our emphasis on quality gives our portfolios strong positioning, even as conditions become more challenging. Looking ahead, here are the key events we're monitoring that could shape the markets in the coming week. The morning of Wednesday, October 15th will bring September's inflation report, one of the most closely watched economic indicators. This measures how prices are changing for everyday goods and services that households purchase. August showed inflation rising to 2.9% annually, so markets will watch carefully to see if this trend continues or moderates. The inflation data directly influences Federal Reserve rate decisions. If inflation cools, it gives the Fed confidence to cut rates, generally supporting stock and bond prices. If inflation remains sticky, it could force the Fed to keep rates higher for longer. Beyond Fed policy, inflation affects corporate profits. Companies with strong pricing power can pass costs to customers, while those in competitive industries may see margins squeezed. We'll watch not just the headline number, but also keep tabs on core inflation to better observe underlying trends. On Thursday, October 16th, the retail sales report will provide a snapshot of consumer spending, which drives roughly 70% of U.S. economic activity. August numbers were strong, with sales rising 0.6%, led by online shopping and back-to-school purchases. September's report is particularly interesting as we head into the crucial fourth quarter holiday season. Strong retail sales would reinforce that consumers remain financially healthy, supporting consumer-facing companies. Weak numbers might signal households are feeling stretched, potentially making investors more cautious. We'll pay attention to these details. Are people still buying big-ticket items, or are they becoming more selective in their purchases? The type of spending tells us much about consumer confidence. Also on Thursday, October 16th, we will get the weekly Jobless claims report, one of our most timely labor market indicators. This tracks how many Americans are filing for unemployment benefits, providing an early warning system for employment changes. What makes this report so valuable is its timeliness. Unlike the monthly jobs report that comes weeks after the fact, jobless claims data is only days old, letting us check the pulse of the labor market in real time. Recent data shows claims are holding at relatively low levels. This suggests employers are reluctant to lay off workers despite economic uncertainty. We'll watch for any signs of deterioration, as rising claims often precede broader weakness. The labor market remains one of the economy's strongest pillars. As long as people have jobs and income, they can continue spending, supporting corporate profits and growth. Any significant uptick would be concerning, while continued low claims would reinforce labor market resilience and support the case for a soft landing. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you next week.